Well, today is February 21st. Matt Marmerstein and I are going to be going through this week's weekly brief titled Will Home Sales Spring Back? Keying off Matt of the February month and moving into spring. We're just finishing our ice storm in Texas, where we had multiple days, if not a week and a half, of just freezing weather. And still, the Midwest is still experiencing that. Is it getting any warmer in California?
It was for a second, and then we just kind of had this real chilly front come in, and it's been fairly cold. It's just kind of been just kind of icy almost feeling. I mean, nothing compared to where you're at. Don't get me wrong, but definitely still a little chilly here.
Well, in a weekly brief a couple of weeks ago, I showed pictures, and the trees, the leaves froze, and the weight of the ends of the literally bent the trees down to the ground.
Yeah.
And so we lost probably 40 trees, and
Wow.
And what was eerie, and I don't know if I mentioned it, but as you're walking around at night, you could hear trees breaking around, because we live in kind of a forest, upcountry, hill country area, and just breaking and dropping to the ground and breaking.
Dark.
Yeah.
Scary.
But anyways, that's spring. We're moving into warmer weathers. Super Bowl is over, and today we had the release of the National Association of Realtors housing report, number of houses sold, and not surprising, house sales declined for the 12th consecutive month. In fact, house sales have declined a total of 43% in 2022. So volume has dropped pretty dramatically. We've got a really nice chart that you can see on our website, upcapitalmgmt.com, and you can see where the 12 monthly declines. That's the bad news. The good news, though, Matt, is it looks like it's stabilizing. It's finally starting to stabilize, which is good news for the housing market. And you're a realtor, so what do you see in what's happened in the last year? And
right. Well, I mean, we kind of had an acceleration of kind of a big event, which was the raising of the mortgage interest rates.
Right.
We basically went from about 2.75 at about a low to about a high of about 6.75.
Right.
And that's only 3-4%, right? But what does that represent? That's a 40% decline in purchasing power, which is a ton.
Right.
And in the meantime, everyone's seeing, oh, my friend sold their house 3-4 months ago, 5 months ago for X amount of dollars that was so high, and they're trying to hold on to that pricing. So you're kind of just in this Mexican standoff, where you want to get this high dollar amount that they saw their friends, family, and neighbors get, but the reality is people can't afford that necessarily anymore.
Yeah, and that was just a few months ago. It's like, why can't I? Why can't I get that?
Exactly. Last time I think we had a big change like this was 2005 to about 2007, 2008, and that was over three years. This was just boom. All of a sudden 40% decline in purchasing power, which is I mean that's incredible.
Yeah. So I don't know about you, but I have lots of stories of clients that said we sold just in time. Literally, in escrow. And the market was changing, and their buyers were able to lock in the rate, and the escrow was able to close. But weeks later, that probably would not have happened. So
yeah, absolutely.
You're right; it was very sudden.
We sold one, and long story short, we just eked by in May and sold it for a great price, and a much nicer house with a pool right next door to us stayed on the market for almost a year and got about $50,000 less.
Wow.
And that was just a month or two later.
Right.
So it really was that dramatic of a change.
Yeah. So what's neat and encouraging in this information at this point of the conversation is, one, it looks like the number of house sales decline is starting to stabilize. So that's good. And also looking at that same chart, we have the mortgage rates, which seem to have peaked in October and have softened. Now, typically rates do soften during the winter months, so that's not unusual. And also with activity declining, especially 43% decline in house sales in 2022, mortgage lenders don't make money by not lending money. So they've softened their rates, and they may stay soft going into spring just to refill their hoppers and get that loan portfolio activity going. So that could be a little bit of a window for those looking to buy a home right now. And I would anticipate that home rates, home prices, and mortgage rates to stay somewhat soft through the summer. I mean,
Yeah.
that's 200% increase. As you mentioned, a significant reduction in buying power. There's not a lot of people that have gotten raises in the last year to make up that difference. So it
Right.
may stay weak going into the summer months as the assimilation of the new pricing market is in place, as they say, the new.
Mm-hmm.
Now, the good news is that housing is reasonably stable. And that's very good for the economy. There's so many factors and downline economic factors that come into play as a result of houses. So with a home sale, there's all the industry of the realtors and the contractors and the title company and the lender and all the fees that are generated, inspections, all the stuff that goes into buying and selling a home. And then after it's bought, then there's the remodeling and then housewarming parties and landscaping and other components that come into play. And all of that is a major factor to the U.S. economy. Consumers represent 2/3 of our economy, and their homes represent their largest financial asset in most cases. So a
Mm-hmm.
stable housing market is very important. And so it's good to see that the bottoming of the decline, which made a lot of sense when you see prices going up, and the housing market will probably remain stable because there'll be a lot of people in the first time in 40 years will be evaluating if they should sell their home because they don't want to lose their mortgage.
Right.
Not whether they want to move or not.
Yeah.
It's just that they sell their home with a 2.75% fixed mortgage, and then they go out in the marketplace today and what is it now, Matt, on a
Yeah. It's
30?
about 6.75. Yeah. Is what we're
Wow.
up to. It's about 6.5 today. Yeah.
Wow. That's
So
a
pretty
big
crazy.
difference.
Another important thing to remember too is that contrary to the crash of 2008, this softening, which is really related to the mortgage rates increasing, is there's a lot of other factors too that will prevent a crash from happening too, and that's how good of borrowers we've had in this last run up. Mortgage borrowers this time have been well vetted, well employed. Appraisals, for example, weren't just willy-nilly call your friend to do an appraisal. They were third party, unbiased. So there's a lot of factors that go into the current mortgages that are out there being really solid mortgages with really solid borrowers, and that's gonna play a big role in people keeping their homes, even if they are a little bit underwater on them.
Right, right. And years past, there's been many times where people were way underwater, but they could afford the mortgage payment
Right.
and they're not going to sell at a loss. Now,
Mm-hmm.
there's another residual benefit that a lot of times we don't talk about is the stability of the employee base. Employees that own their home tend to be more dependable as employees. They tend to be more positive. The pride of ownership is big. There's real intrinsic value of being a homeowner. I can't tell you how many people I know, first-time home buyer, including my kids. What a sense of confidence that is, and self-worth that you own your own home. Also, homeowners don't get up and leave as renters would. They tend to stay. So the residual benefit to the employers is an employee base that has largely owned their own homes tend to be better employees. So there's a lot of good in a stable housing market, which is what we see. And so that's good news. And one of the other conclusions that we've been making several times is the second guessing of the Federal Reserve, because Jerome Powell, March of last year, began his committee began the rate increase, and boy, the doomsayers came out. If he starts raising rates, which he did 9 times, that he's gonna send the economy into a recession or worse. Housing market's gonna collapse, and the beginning of a 2008 Great Recession all over again. In fact, it's going to be so bad that he's going to have to quickly switch gears and reverse the trend and start lowering rates. And so that was all of last year, right? You remember that, Matt?
Yep.
And now here we are, February 21st, and doesn't seem to be any of that on the horizon.
No.
In fact, housing prices have somewhat stabilized, which we talked about would probably be the case because people have 2, 3, 4% fixed rate mortgages. That's cheaper than renting.
Yeah.
Why would they sell? And we've got the best unemployment rate since 1969, more people working in the history of this country. So we commented several times how the doomsayers projections just didn't seem to pass mustard.
Right.
So right now it seems to be that the rate hikes did their job, slowing the economy down and price increases, which is what their goal was, without the damaging impact on the economy that Jerome Powell and the Federal Open Market Committee assessed correctly, that there was margin for rates to go up. It's also worth noting that the U.S., as always, is leading the rest of the world in fiscal policies and monetary policies that are allowing the economy to stabilize and be in a position to have sustainable growth. One last comment that you and I haven't talked about, but it's very important that the Federal Reserve raise rates whenever they can. The government doesn't seem to figure out, in good economies, you pay down debt. In bad economies, you have to take on debt, right? They don't seem to figure that out.
No.
In good economies, they take on more debt, and in bad economies, they take on more debt. They never pay it off. But the Federal Reserve, and Janet Yellen did this after the Great Recession in 2008, she began bumping rates. She was the only central banker in the world to raise rates in 2010. And still there was many countries with negative interest rates, which means the borrower was paying, the lender was paying the borrower to take out a loan. How cool would that be?
Yeah.
And now Jerome Powell's done the same thing, has taken the discount rate from 0.25 to currently 3.75. So what that means is that when, and not if, when we move into another slow period or recession, the Feds have something to work with. They have some bullets in their gun to be able to help stimulate the economy and soften a recession. If you have nowhere to go at zero, you're in trouble, as countries were, and that's the negative interest rate that they had to do. They had nowhere to go, so they started paying the borrowers money to borrow money, which is bad.
Yeah.
So we're 2/3 into the first quarter. Seems to be pretty good, huh, Matt?
Yeah. No, things are going great. And, in my neck of the woods, just, as a real estate agent, showings have picked back up a lot. And we're, just getting towards more of a normal market, which is a good thing. People got used to, things getting, bid up and sold in 5-7 days. But, the reality is when you sell homes, that a lot of times they'll be on the market for 60 days. And that's how it normally is.
Yeah.
And so normal isn't a bad thing.
Right. Yeah. The days of 3 days and 40 offers.
Yeah.
It was great. All right. Yeah. So last two comments that we'll talk about is a technical of the S&P 500 and NASDAQ. So both of them have sold through their 20-day and 50-day moving average, which it will do when it has a pullback, which is what we think this is. What will really be a test of the strength of the investors' support of the market and the stock market will be its 200-day moving average. So we would like to see it bounce off. Neither one are through their 200-day moving average, although very, very close as of today's sell-off. But it would be good for it to bounce off the 200-day moving average. It not unlikely to drop below it, but slightly recover quickly. So that would be a very good sign technically for both those major indices to do that. A real negative is if they drop below the January 2nd low point that we had, and we're well above that. So what we want to do, and the charts, by the way, are on our website, upcapitalmgmt.com, is to look at how we've been on a trend since October of higher highs and higher lows. So we don't want to break that trend. We want that trend line to be continuing up. So that'll be something that we'll be paying attention to and commenting on in the weeks ahead. Anything else, do you think, Matt?
Yeah, no, I think those are really good points. And yeah, you've taught us that, the 50-day moving average and the 200-day moving average are just, really easy things that you can key in on to really follow to see if we're ready for another drop or if we're going to be, going back up to higher highs. So I think just like you said, paying attention to that is really going to be the key to know where we are in the market cycle.
Yeah, we've talked about moving averages sort of like tracking a baseball player. So a couple of bad games, 3-6 at bats, not a big deal.
Right.
A couple of weeks of bad games consecutively, not good. Now you're working with your batting coach, right? What's wrong? Am I in a slump? And after 3 months, you're definitely in a slump.
Right.
And that's what the 20 days and the last 50 days and the last 200 days, they give us an indication of what investors are doing and how many days is the market going down versus going up. And if it's going up faster daily than the last 20 days, that's good. And faster than the last 50 days, that's good. And certainly the last 200 days. So that's what that moving average is. It gives us kind of a high level, but a technical net assessment of the markets.
Makes sense. Yeah.
Well, good. All right. Well, another good podcast, Matt. Some good information today. Thank you for your input as your role in real estate, as well as working with Up Capital and all of our clients. Appreciate what you do there. So we'll talk to you next week. And we also want to introduce, starting in March, we're going to have Fun Friday. It's may or may not incorporate financial information, but it'll be off topic, if you will, stuff that interests us that may or may not involve finances. So we're going to start that in March. Fun Fridays, keep that on your radar. We'll be sending that to you beginning the first Friday of March. So we'll talk to you soon. See you later.
Thanks.
Bye.